Hey guys, I'm here to answer some questions from y'all. Thanks for submitting them. The first one that I'm going to go over is a question from Sophia. Sophia asks, from a tax perspective, should we invest in multifamily from a solo 401k or a self-directed IRA? Real estate has a lot of tax advantages, and so it is actually very useful a lot of times to hold the real estate in a way that's considered taxable because you may be able to generate losses through depreciation or other items. You may be able to refinance tax-free and use those proceeds for more investments, all things that, we've talked about in some of the various videos. And so I think generally speaking, it's not always a good idea to have it in a retirement plan. However, if you're a passive investor in real estate and maybe you're not able to offset some of your other income with it, or you have less control over the real estate, it may make more sense to invest through a retirement plan as opposed to investing in other types of assets like equities or things like that. You may still be able to get better returns. It just kind of depends on your investment goals and things like that. The other piece that's important to remember is that there's such thing as unrelated business taxable income, or UBTI for short. And this is generated if you have leveraged real estate. In retirement plans, you may be subject to this UBTI tax. So it's not necessarily tax-free having real estate in retirement plans. I would say there's a lot of factors to consider in determining whether you invest through a retirement plan or not with real estate. So definitely talk to your financial advisor, talk to your CPA about your specific investments before you do it, and figure out what the right solution is for you. The next question I have is from Benjamin. I'm looking to do 2 cost segregation studies on a 14-unit and a 10-unit property. However, I wanted to double check with you regarding one component. I've heard from a tax strategist that usually only the non-structural components of a building can be bonus depreciated as the remaining useful life is less than 20 years. From your experience with cost segregation studies, how much is the ratio of non-structural versus structural components in a multifamily building? Is it close to 80% non-structural and 20% structural, or the opposite? Okay, so I think most of the information here is fairly accurate, where it's generally the non-structural items that are eligible for bonus. So I go in more detail on the cost segregation video, so go ahead and reference that for a lot of information. But generally speaking, in a cost seg study, you're breaking out items that are movable from the property. So if it's residential, like in this case, it's your refrigerators and other appliances, it's the carpeting and things like that, countertops, all of those items are shorter life items and considered non-structural. So those would be eligible for depreciation. Also, land improvements, so fencing or parking lots, curbs, those types of things would be land improvements, which are also shorter life assets and eligible for bonus depreciation. Now, the percentage that you could overall write off when you take all of that into consideration really varies significantly between properties because it depends on the age of the property, when it was last updated. So obviously, newer properties or properties that have been updated more recently, you'll have more of that type of property or more value in that type of property that you can write off. It really ranges somewhere between 20 to 40% of property or cost of the building after land you can write off. So that's just kind of a ballpark. For newer properties or remodeled properties, closer to 40. An older property that hasn't been updated, more like 20%. So it just kind of depends, but that can give you kind of a good ballpark. But any good CPA or company that's going to do a cost segregation study should be able to give you a projection for that before you start the study. So I would definitely check with them first. All right, this next question is from Sahin. Hopefully I didn't butcher the name there, but this question is, would it be good choice to do an LLC for my property? I'm living in it now, but I will want to rent it out next spring. and I would like to leave this to my son in the future. If I want to do a 1031 in the future, would an LLC be good? My first answer would be definitely talk to a legal expert, because an LLC, when you're the only owner, a lot of that comes down to a legal consideration and protecting the asset. From a tax perspective, if you're the sole owner, it generally doesn't change a lot. You mentioned leaving this to your son. You may want to consider discussing some estate planning with an estate attorney or a CPA that's knowledgeable in this. You may want to set up revocable trust or other types of trust, and maybe the trust would hold the asset. That way you can escape probate and things like that. So I would definitely talk to a state attorney and someone familiar with LLCs and corporate law for some of that legal side. As far as whether you're renting it out versus living in it, I think generally from a tax perspective, it's easy to create an LLC. It's relatively low cost. So I generally recommend to have things in an LLC, whether you're living in it or it's a rental property. So solely from that perspective, I'd do it, especially if you're in a state where there's not annual filing fees. In Arizona, it costs less than $100 to set up an LLC by yourself. If you have an attorney, maybe it's a few $100s to help you set it up. So it's relatively low cost. And then there's not any kind of annual fees for an LLC. So once you set it up, it's done. And then as far as a 1031, again, if you're the only owner, there's not really a difference on whether it's in an LLC or your personal name, because a single member LLC is disregarded for tax purposes. The only item I'd make sure you're aware of is that if you're living in it, you can't exchange a personal residence in a 1031. You'd have to rent it first, turn it into a business asset effectively, and then do an exchange. So keep that in mind. Hopefully that gives you a good direction to go in and answers your question. Thanks for your question, and I look forward to seeing you guys in the rest of the videos.